I don't think we're going to have a disaster. Neither are we going to have a strong recovery. So the problem we're facing is that China clearly exhibiting quite a few signs of being in a liquidity trap. Now, there is a way of getting out of liquidity trap, but just a small actions, like a little bit of cut in interest rates, a little bit of liquidity, is not going to do it. But remember, China is a state capitalist system. In other words, Lehman Brothers moment or Minsky moment is not possible in China. It doesn't mean that Chinese don't pay for it, and in fact you can see the declining productivity and the declining efficiency of capital utilization, but it doesn't mean that it's going to be a disaster. And that's why I think people expecting disaster will be wrong. I think people expecting that the government suddenly will change position and inject a lot more stimulus also will be wrong. And that's where you've got in trading terms. The market doesn't really know which way to go.
Can I just ask you, and it goes to what you probably heard Sam suggesting previously in terms of that, that Chinese hedge fund manager, Li Bei, that was suggesting that, the foreigners are to blame for the volatility. We've seen, obviously, all of the flow on the northbound channel coming in net negative over the course of the last couple of weeks or so. But if China is suggesting, to some of their own, local funds to be buying up equities, isn't that the easiest fix, and it doesn't have anything to do with foreigners because there's that much capital just sitting there on the sidelines, even if you're talking perhaps even incentivizing domestic holders with tax breaks or stamp duty cuts and then get involved in the market, because that's probably the easiest fix when it comes to incentivizing re-entry into the equity markets in China.
Yeah, I think we have to separate economics from markets. These are two different things. They related, but related very, very tangentially. Now, if you think of economy, what do you need to do? Well, number one, you do need some kind of a restitution trust for real estate. You've got to do that. Number two, you've got to stimulate consumption directly. And we're talking about vouchers. We're talking about checks. Number three, they need to invest a lot more, not in infrastructure, but instead into healthcare, social services, into UBI. That's what needs to happen. And China has a capability of doing it. It's just for a number of reasons. Decisions are not made as quickly. In other words, the way I look at China, it used to be pragmatic and flexible. Now it is much more rigid than it used to be in the past. Now, the market itself is a different issue. Can you get your A team to support your market? Absolutely. Remember, relationship between A shares in China and MSCI China, again, is not direct, because there are capital controls. But they are like two planets. They're circling each other. So if you manage to pick up the domestic market, almost inevitably, it will be reflected in MSCI. What we're seeing, I think, right now in China is hesitancy by policymakers in deciding exactly how far they want to go. And some of that hesitancy actually is justified, because you need to worry about efficiency of capital utilization, you need to worry about rising debt levels, and you need to worry how you're going to grow going forward.
But wouldn't the expectation be that if you were to get the A team to work on the A shares and you were to pair it with some kind of stimulus, like you were mentioning in terms of consumption vouchers, which I could not agree with you more that is incredibly, indelibly necessary, doesn't that all just, even if it's at the margins, more targeted but more effective if you're really realistically trying to boost people's confidence in the broader economy? Because you've got a lot of people that right now, because of what's happened in property, what's happened in the equity markets, they don't trust enough to speculate and they'd rather stuff their money under their bed.
Yeah, that's right. And that's your essence of a liquidity trap. Essentially, liquidity trap is all about demand for money, not the supply of money. That's why monetary policy becomes relatively impotent during those periods. And so you need to shake the economy out of it. And the best way of doing it is to instill confidence. And the best way to instill confidence, as I said, is creating some kind of a restitution trust for real estate. That's the best way to go forward. But as I said, there is a price to pay. Because remember, the leadership of China really emphasizes quality growth. They're really emphasizing productive investment. Now, those two ideas do not gel with the way financial markets work and the way the monetary economy works. So long as you've got this conflict, unless decision at a very senior level is made, or unless circumstances massively change, you've got those half measures, which we've been experiencing for the last sort of 6-7 months.
There have been a lot of half measures, though, Viktor, and a lot of them going into some of the areas that you're talking about, perhaps not at the volume and the scale that you think is necessary, but they do seem to be aware of that particular line of thinking, particularly when it comes to property, right? I mean, property in the past, it would just be, okay, let's spend more investment money on property, get those prices up there, get that market moving. They don't really have that capacity to do that anymore, given the way that market has now evolved and the amount of debt that's involved in it. So what would a restitution trust look like? How would that manage itself, and what part would it play in that broader scheme?
Lifting the debt. Very similar what they've done for the banking sector. If you go back into earlier 2000s, there were various restitution schemes for the banking sector. In fact, they've done it 3 times. So it's not that they haven't done it in the past. It's basically lifting the debt, lifting the debt burden, and then gradually rationalizing real estate over a prolonged period of time. That's a way to look at it. As I said, go back to the playbook, the way China cleaned out banks 3 times over the last 20 years.